Welcome back to Investing Talk Podcast.
Today we're looking at Safe Harbor, a company that has executed one of the most remarkable financial transformations we've analyzed recently.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're examining how this specialized, cannabis-focused fintech platform has moved from, well, the brink of financial distress and potential delisting to a position of being debt-free and fully capitalized for massive growth.
Okay, let's unpack this because brink of distress isn't really hyperbole here. Safe Harbor had some serious financial health concerns hanging over it for a long time. It sounds like management didn't just tweak the balance sheet. They performed, major surgery. What was the core of this recapitalization?
Major surgery is exactly the right analogy. The key action was a strategic, dual-pronged approach. First, they raised $6.8 million in fresh capital. Second, and this is maybe more important, they simultaneously eliminated $18.8 million of existing high-cost debt. When you look at the net effect, they achieved nearly a $26 million positive swing in their financial health, all through one set of coordinated transactions.
That is profound. They essentially went from being heavily levered and, resource constrained to being nearly debt-free. But the impact goes beyond just the balance sheet numbers, right? I mean, what about the shadow of that Nasdaq delisting risk?
That's the crucial point that investors really need to grasp. Being nearly debt-free isn't just a financial comfort. It allowed the company to regain compliance with Nasdaq listing requirements.
The shareholders' equity and minimum bid price rule.
Exactly. For any public company, the threat of delisting introduces a massive, often irreparable investor overhang. Removing that existential risk is perhaps the single most important outcome of the entire recapitalization. It completely shifts the narrative.
That's fundamental de-risking. An investor can now stop worrying about survival and actually start focusing on execution. But the cannabis industry, especially the regulated banking side, requires serious capital. If they shed all that debt, where is the fuel for future lending operations even coming from?
This is the genius of the forward-looking funding strategy. Safe Harbor didn't just fix the past, they secured the future. They established a substantial equity line of credit, an ELOC, for $150 million. And crucially, that facility is expandable up to $500 million.
An ELOC is a powerful tool. But for listeners who might not be familiar, why is this arrangement strategically better than, say, a traditional debt raise or just constant stock offerings?
An ELOC provides financing on demand. It means they don't have to time the volatile public equity market every time they need to fund a new tranche of high-yield loans. They now have immediate access to significant capital, and $150 million is a massive amount for a microcap company to finance their future lending to cannabis-related businesses. It provides consistency and scalability.
So they don't have to worry about capital availability all the time.
Exactly.
So they have the long-term growth funding sorted. But what about improving liquidity for their daily operations? I mean, lending cycles can sometimes tie up operating cash flow, making it hard to invest in the platform itself.
They address the operational cash flow issue, too, which really speaks to management's thoroughness. They successfully modified a major debt obligation with the Colorado Credit Union. This modification was key. It unlocked over $6 million in operating cash flow that was previously just earmarked for debt service.
Wow.
So that money is now available for growth investments in the platform, in sales, in technology.
That's a huge operational buffer. And on top of that, they pushed the debt maturity on that obligation all the way out to October 2030. Which gives them 6 years of clean runway.
It does.
So if we look at the entire financial trajectory now, they have pivoted from a weak balance sheet and facing delisting threats to being debt-free, fully funded for growth, and boasting significantly improved operating liquidity. That is a complete structural reset. It forces a complete reevaluation of the company.
It absolutely does. They are now operating from a position of financial strength, which lets us look past insolvency risk and dive into the core engine of their business model, which is, their true competitive advantage.
Let's do that. Because calling Safe Harbor a bank is technically a little misleading. Clarify for the listener what exactly Safe Harbor is and how it manages to service this highly regulated industry without actually being the bank.
It's a crucial distinction. Safe Harbor is a specialized fintech platform. You should think of them as the compliance layer that sits between the cash-heavy cannabis industry, the dispensaries, the cultivators, and the traditional federally insured financial institutions. They partner with FDIC or NCUA-insured institutions.
The actual banks and credit unions.
Right. Those partners provide the regulated balance sheet, but they generally lack the compliance expertise and technology that you need for cannabis.
So Safe Harbor provides the bridge. They take the risk and the complexity out of cannabis banking for the traditional financial institution.
Precisely. They supply the entire operating system. The compliance protocols, the robust anti-money laundering or AML and Bank Secrecy Act or BSA monitoring systems, and all the specialized workflows that allow a bank to serve a CRB's cannabis-related businesses in a fully compliant manner. They own the compliance rails, which is far more scalable than owning a branch network.
That infrastructure seems to create a powerful competitive advantage, a moat, built on regulatory necessity. How deep is that moat, and why can't a competitor just stand up a similar system?
It's deep because it's built on time and regulatory trust. Safe Harbor has a massive first-mover advantage. They launched the first fully compliant cannabis banking program in the U.S. way back in 2015.
2015.
Yeah. They were working with regulators and auditors long before most others even considered entering the space.
That means they have nearly a decade of institutional knowledge and, maybe more importantly, transaction data. What does that historical data translate to in real business value?
It translates into unmatched regulatory compliance, predictability, and scale. They've processed over $25 billion in cannabis-related funds. They operate across 41 states and territories. No new entrant can just instantly replicate that historical data.
And that data lets them price risk better.
It lets them price risk better, onboard clients faster, and most importantly, provide auditors and regulators with the highest confidence level that their BSA and AML monitoring is effective.
That's compelling. But let me challenge that moat idea for a moment. What happens if federal reform finally passes? If the federal government passes something like the Safe Banking Act, allowing the traditional mega banks, a Chase or a Bank of America, to enter the space, doesn't Safe Harbor's competitive advantage just immediately flatten?
That's the bear argument you hear a lot, but it misses a critical nuance. If safe banking passes, it actually increases the regulatory burden because it brings federal regulators like the FDIC and the Fed into the picture with full force. A big bank won't suddenly stop needing to comply with complex state-by-state laws and transaction monitoring.
So the need for a robust, proven compliance infrastructure actually scales up.
It scales up dramatically. So if cannabis banking normalizes, the need for Safe Harbor's compliance operating system becomes even more critical because all these traditional institutions will be competing heavily but still lack the specialized tech to handle the intricacies.
So their infrastructure, not just a service provider.
Precisely. And they haven't stopped at compliance. They've expanded far beyond basic deposit banking to offer a complete financial solutions platform. This includes lending, cash management, digital payments, CFO advisory services.
So by offering this end-to-end platform, they embed themselves into the daily life of the cannabis business. They capture multiple profit pools for client deposits, payments, loans, back office fees. That makes them much, much stickier.
It creates significant switching costs for the clients. Now, let's pivot to operational performance. The balance sheet reset is the foundation, but the house needs to generate profit. What traction are we seeing?
We're seeing real operational inflection that validates the model. The company has demonstrated positive adjusted EBITDA for 3 consecutive years, so the underlying economics are sound. And the key area driving current growth, fueled by that $150 million ELOC, is lending.
And that lending book is scaling impressively. Loan interest income was up 48% year over year in the most recent quarter. If you look at the 9-month period leading up to that, loan interest income grew by an astonishing 143.5%.
Wow.
I mean, that tells you they are successfully deploying capital into high-yield cannabis loans and that the demand for that specialized financing is incredibly robust.
And we are finally seeing the growth translating to the bottom line, moving from just operational efficiency to actual overall profitability.
That's the major turning point. They reported net income growth to $0.4 million in the third quarter of 2024. Crossing that net income positivity line, that validates the pivot to a higher margin, lending-heavy platform model.
Especially with that increased mix toward specialized fee-based services.
Exactly.
That brings us to the 2 major new product launches. The growth catalysts that promise to be highly EPS accretive in the near term. What's the first one? One focused on the client experience.
The first is the Payroll Boost solution, which is coupled with a major partnership with Canopy HR. Payroll Boost is a simple but really high-value tool. It helps cannabis businesses improve their liquidity by extending the time they can hold payroll funds by up to 2 additional days.
For a business operating largely in cash, having 2 extra days of float before running payroll is a massive benefit for daily treasury management. It's a solution that shows they really understand the liquidity pain points of their clients.
And the Canopy HR partnership delivers the distribution. Canopy HR is a leading cannabis payroll provider. This partnership gives Safe Harbor direct, pre-vetted distribution into a huge established client base. It functions as a powerful wedge product, allowing them to cross-sell their full suite of services.
So they don't have the heavy sales friction.
None at all.
So that's a direct distribution advantage. The second catalyst, however, is much more focused on the financial institution side, right? Targeting high-margin B2B revenue.
Absolutely. This is the launch of the industry's first fully managed cannabis banking program for financial institutions. Essentially, Safe Harbor is now offering its decade of expertise as an outsourced service. They allow banks and credit unions to entirely hand off their cannabis compliance and program management needs.
So if I'm a smaller regional bank or credit union looking to enter the cannabis space, my choices are either spend millions building my own bespoke BSAML compliance stack, training staff, dealing with auditors, or I can just plug into Safe Harbor's proven decade-old management program.
It's an immediate high-trust and significantly lower-cost solution than trying to build it internally. This creates a massive, sticky B2B revenue stream for Safe Harbor. Once a partner bank's compliance workflows are embedded into Safe Harbor's management program, the switching costs become astronomically high. It dramatically deepens that regulatory moat for the next decade.
We spent a lot of time on the turnaround and the growth story, but a proper analysis requires a balanced view. Despite the financial reset, what are the primary risks the listener needs to consider right now?
The risk profile has simply shifted. It hasn't disappeared. The primary risk is execution and dilution. That $150 million stock purchase agreement, the ELOC, is fuel for growth, but it involves the potential issuance of common stock.
So if that facility is drawn down when the stock price is low,
Existing shareholders will face meaningful potential dilution. Growth has to exceed the cost of that capital.
that financing structure is complex, and the growth needs to materialize pretty quickly to avoid that dilution penalty.
What about operational risk? I mean, they rely so heavily on those partnerships with traditional financial institutions.
That partnership reliance is key. While their track record is strong, processing $25 billion without a major incident is impressive, they are still dependent on those partner institutions. A failure in their own BSAML compliance or an adverse regulatory event at one of their partner banks.
It could severely damage their reputation.
And their ability to operate nationally, technology stability and just the inherent risks of dealing with cash-heavy industries remain ever-present.
And, of course, the ever-present federal regulatory ambiguity we talked about. While we believe normalization increases the need for compliance infrastructure, the market could still react negatively to sudden legislative changes or even delays causing volatility. That inherent regulatory volatility remains a factor. It differentiates this from a standard fintech platform. However, despite these risks, the market seems to be validating the turnaround story already. What does the stock price action tell us?
It tells us the market recognized the pre-recapitalization state as a massive risk discount. The stock surged approximately 77% over the last 6 months, and following the capital access announcement, the ELOC, we saw a single-day jump pre-market of nearly 187%.
That kind of violent positive movement isn't a slight correction. It signals a market regime change. It validates that the removal of solvency risk and the securing of massive growth capital are being fully recognized by investors as fundamental value creation. It's a huge breakout from deeply depressed levels.
So bringing it all together, the final thesis summary is that Safe Harbor has moved from a survival story to a leveraged growth play on cannabis banking normalization. And this play is underpinned by a massive decade-old regulatory moat and newly secured ample funding for high-margin loan expansion.
The combination of restored Nasdaq compliance, the platform scaling opportunities, and the new high-margin revenue streams from the B2B side creates a very strong investment case. It justifies a multi-year investment horizon, we're talking 12 to 36 months, for those willing to tolerate the micro-cap volatility that's inherent in this sector.
That leaves us with a final provocative thought for you, the listener. Given Safe Harbor's unique first-mover advantage, its deep regulatory track record, and now the launch of the B2B Managed program for other financial institutions, the question becomes, Is Safe Harbor now positioned as a plausible, perhaps even inevitable, acquisition target for a larger traditional financial player, just waiting for clear federal reform to purchase a ready-made, regulatory-vetted cannabis banking infrastructure?
That consolidation potential is the ultimate premium that might define its exit valuation.
Make sure you subscribe to Investing Talk podcast so you don't miss our next analysis.